Hi, Tushar. Thank you so much for
Hi, hi, Max. How are you doing? Thank you so much for having me on your show.
That's my pleasure. Thanks for your time to be with us and giving some great tips and knowledge to our founders. So let's start giving an introduction on yourself.
Sure. I am the founder CEO of Kansaltancy Ventures. I've supported startups and growth stage companies in diverse technology and non-tech sectors. One can have a look at my LinkedIn. There are more than 50 recommendations. I was awarded the best startups speaker supporter at an event by Dr. Kiran Bedi, who's the first Indian female IPS officer of India. And I'm a venture advisor with Loyal VC, which is a INSEAD-led Canadian venture capital fund, having a core portfolio of over 220 investments in more than 50 countries. Uh, and over the years, I've given more than 200 webinars. I've been featured on CNN News 18, Venture Capital TV, Business and Economy. We are networked with more than 1,000 global investors. We do invest from our own book as well. And academically, I did my leadership studies from Harvard Business School and MBA Finance from University of Delhi and engineering in from Textile Technological Institute of Textile and Sciences, which is affiliated to the Textile Institute Manchester.
Thank you, Tushar. That's a very solid background. Uh, Let me start with the geography. Where do you prefer to invest and where your consulting are based mostly?
Uh, so while our head office is in Delhi, India, but we do have offices in UAE, UK, US, and Singapore. And the geographies which we prefer are APAC, which includes South Asia and Southeast Asia, uh, US, UK, Europe, some countries, the Western Europe side, India, and the United Arab Emirates, specifically Dubai. So these are the geographies which we prefer.
In those geographies, do you consulting and investing as well, or when it comes to investment, you are more keen to invest in India?
No, we are also investing, wherever the purchasing power of the people are more, we like to invest there because we believe in technology-led, consumer-led themes, specifically on the smartphone. The purchasing power of people is very good in the regions which I just mentioned.
Okay. So in terms of investment, how much normally do you invest with yourself
Invest
and your team?
from Yeah, it's from our own book. It is $200,000 to US dollars to $1 million, and when we are assisting from our network, then it goes all the way up to $25 million.
That's a very broad and range, which means you invest from the very early up to growth stage.
Right. We invest pre-Series A, Series A. That's our sweet spot. But having said that, we have also invested in seed stage as well. But we prefer more for pre-Series A and Series A.
Okay. I mean, be an early stage investors where I do believe is the most complicated part is investing when startups is still not there. You mostly rely on the founders. What are the top concerns for you, and where do you find conviction when start deciding to invest money? The company, team, the product, the service.
For me, the team comes first because we are essentially betting on the founders. A good team can change a bad product. So product comes second, but startups who achieve product market fit, that is the most critical aspect. A product market fit achieved in a challenging market is most desirable. Company would mean the sector, geography, economy, and the stakeholders. To simplify, we really like a team that has this capacity to recruit world-class skills and to capture the hearts and minds of the people that really matter in their industry. One can diligence that even remotely. But you sort of feel it immediately when you sit in a room and talk to someone who really knows their stuff. Second, market is big enough that it can create a massive business over time. That is very crucial. Third, we would like to see a fundamentally differentiated product, one that has the capacity to really stand out with just a modest amount of marketing. So these very three simplistic arguments held very true since many years, and they still hold true for us today also.
Thank you so much, Tushar. We are just getting out from the pandemic, where before was very obvious that investors, they love to talk face-to-face to founders, which means sitting and talking in person. And after what happened, we shift to online meeting. How important is for you face-to-face, in person?
It's good to meet because it builds a personal rapport. Just as we do a due diligence, which includes checking the founder's background, and we see founder market fit as well. So, a warm relationship goes a long way in the investment decision, because exits are made almost after 5 years, 6 years, 7 or 8 years. It's difficult for us. Uh, for companies that are starting after during COVID, because as a small company you build so much trust together, and you are starting small. So in this pandemic, it's hard to create that sense of trust, the trust that you gain when you have a shared space. You have a small team, you can't rapidly exchange ideas or sort out misunderstandings, because you have to schedule for everything to be done over a Zoom. And feedback, instead of quickly chatting to the team when you meet them in the hallway or cafeteria, you have to schedule a talk when it's convenient for both of you. So at least in the internet, the internet lets you recruit talent regardless of where any person is, because they can use it to contribute to the company. So we would like to meet face to face, but having said that, we do understand that things have changed drastically post COVID.
I mean, I do believe the face-to-face creates something different, but you need to do what is needed. Sometimes you just, regardless COVID or not, sometimes you just can't go there all the time. So you need some tool to help you.
Absolutely. Sure.
I mean, in terms of meeting before and after investing, how many times you like to meet your founders?
Uh, it There is no fixed number to it, but ideally 2 to 3 times works for me, because the quality of the meeting is more important. How well we are able to understand each other, because the relationship goes for 5 to 8 years. Then we have to sit across and ensure that uh, the common vision with which the startup is working and we are investing, it goes a long way. So 2 to 3 meetings is what is my comfort zone.
And after investing, how involved
After
did you get with them?
We do get involved quite a lot. We monitor the portfolio, and we have meetings to assess any help required from our end. So I'm always a one call away. Having said that, usually we take compliance feedback from the startups once every 15 days, a fortnight, and we are we fix meetings twice a month minimum with the startups, be it online over Zoom, or physical meetings can be done over a small get together, which we arrange every month.
I mean, in terms of added value, how do you add value to the startups you invest in?
We add value in the form of three things. One is the network, which means the relationships. Second is the capital, which is the money. And third is management know-how, because we have invested in companies across geographies. So we do understand at which stage each sector is in a particular country, and how uh, the other companies behaved in more mature markets. So we are able to provide a good best practices kind of know-how. Mostly it is these three things. Networking is a big part of it, because these companies, they need a lot of help in getting businesses, in getting quality manpower, and also apart from the cash, they need process know-how, and they also need a lot of mentoring. So We are there to provide them networking, capital, and management know-how, which means the best practices.
I mean, in terms of leading, do you prefer to lead the round or follow?
No, we don't prefer to lead in the first round. If the company is taking external investment for the first time, we prefer not to be a leader. But we don't mind leading in subsequent rounds. Once we have invested in a company along with others, we don't mind leading in subsequent rounds, especially for sectors which we understand well and where we have formed an investment thesis.
I mean, when you invest early and the startup needs new investments, so new rounds, do you get involved in introducing the startup to new investors?
Yeah, we do get involved. We not only help them with their collaterals, like perfecting their business plan, perfecting their financial model, but we also help them with things like how to, present themselves to the investor. What are the unit economics of the company? How should they present it to the other investors in case we are getting money from other investors? And we also help them in frequently asked questions and how to structure the deal. So essentially, negotiating a good term sheet. So while wherever we are leading, we have our term sheet, so we are sure in which form we are investing. But when others are coming in, then we handhold the company in that fashion.
I mean, I've been talking to pretty many investors so far, and what I can see, the difference came to my mind is when it comes to having some kind of interaction between the startup, no, to some extent. For example, corporate VC, they are more keen to have a portfolio startup that can actually work together. Is something similar happening with you?
Yeah, I mean, I can give you some examples. One of our investee companies was in a very generic agri kind of trade, and they were not able to create a brand value. So we brought one of the leading celebrities for as their brand, celebrity, and that we knew the best commercials this person will charge. So once there was a success there, we realized that we can replicate this across other companies in our portfolio. And just as an example, so there were other companies as well who benefited from having celebrities with a similar low kind of good kind of commercials. So uh, when there are companies helping out each other, they can always help out in many ways. So one is that relationships. So if one company of ours is coming out with an IPO, and there are lead investors in the IPO with whom they have relationships, we don't mind getting that startup to share those relationships with the other investee companies.
What can be your advice for founders when time to pivot comes? Sometimes, many times, they do not understand. So they think they are giving up, and they believe pivoting is pretty much a proxy of failure, which is not.
Pivoting happened with more than 50-60% of our startups during COVID. It was a necessity. They had to pivot. And while digital transformation happened across a number of companies, I won't call it a pivot, but a lot of companies utilize digital transformation. When it comes to pivoting, it becomes like a fresh investment decision. So, there is a company which is working on a particular business plan. And while, we understand that we have a portfolio, so some companies in the portfolio won't do well. We know that. But having said that, each investment of ours is has taken effort. So we do treat it as a fresh investment decision, whether the particular risk return scenario, if the company pivots to a new business model, would be really beneficial. And if it won't be beneficial, then are there other options like mergers and acquisitions or cashless swap of shares with investee companies of other investors. So we explored those kind of partnerships, business side partnerships, and balance sheet side associations. So uh, so pivoting to a entirely different business model is like a fresh investment decision for us, actually.
Yeah, I do believe so. But as I do believe, if needed, must be done.
Sure.
Uh,
Absolutely.
why did you end up being investor?
I was always a voracious reader. I mean, since school, I'm reading 3 hours every day. Till today, I read so much. So I have a deep interest in understanding economies, markets, sectors. It comes very naturally to me. And having worked in all aspects of core finance, like private equity side in Deloitte and Touche, like the buy side at a venture capital fund, which is India's largest. Owned by Times of India Group, and then doing treasury operations at one of the largest telecom companies, and then raising $3 billion of debt for as head of treasury for one of the Russian telecom companies, and finally as chief financial officer with a company owned by Guggenheim Partners, the American private equity fund. I had the exposure for all aspects of finance. So one factor was whether one needs, in an entrepreneurship, whether you generate cash flows from profits or from the balance sheet side. And I found a significant opportunity in unlocking value through balance sheet side. And see, interest rates are low, so passive savings are not an option. But that means it's easy and cheap to borrow money and invest because the same money is chasing better returns.
Yeah.
So the amount available for investing by VC funds is increasing manifold globally, but that has also meant increase in valuation expectations. So I believe that as long as you identify the right winners with a high strike rate, valuations will grow exponentially in your investee company as well, because they are always, the valuation is always a multiple of the action on the profit and loss side of the business. So I find this whole opportunity very exciting. And also we are learning all the time, but having said that, have been trained academically and from an experience point of view.
Thank you so much. I mean, these are very great insights. Let me ask you, if you had three startups, very similar, but you need to decide which one to invest your money, what can be how the decision is made? What is the most critical points that will trigger your decision? Okay, I'm going to the right one and not to the left one, to number one and not a number two, because what?
See, if a company is lazy so as to not recognize the changing headwinds of the markets, then one needs to stay away from that company, no matter how uh, good the founders are or how big the company is. I believe that the convenience and innovation of digital alternatives has turned what started as a pandemic era necessity into a preference for consumers and a competitive advantages for businesses. So, like some observations, there has been an increased adoption of enterprise software in the workplace. So, as employees return to offices, the lessons learned from the pandemic will remain. So, employers were forced to digitize their operations to be more agile and efficient, even when workers were at home. So, as a result, AI-driven enterprise workflow, customer success, employee management, and workplace collaboration tools gained popularity. So, they were the driving factor. This trend is difficult to miss. So, uh, just like this trend, there is a trend in fintech and the rise of the retail investor. So, 2021 and 22 marked the the rise of the retail investor and the continued dominance of fintech, driven in part by consumers turning to digital only financial services in the age of social distancing. So consumers are taking control of their financial well-being, and swaying the markets by themselves rather than turning to traditional financial services, which are not as convenient and cannot access all asset classes and investment strategies that the everyday investor may want. And the third trend which we see is that digital access to healthcare has become a necessity. So more patients and providers are now providing convenient services online, like medical consultations, therapist appointments, remote health monitoring. So this is all these trends are a wave which any investor has to ride because the other alternatives are not so good.
What is the perfect recipe for a great pitch that can convince you?
It's like asking the founder to explain his business in 10 minutes. A great pitch should have three things. First, a company's vision and results, and that should include existing business, growth, strategy, and vision. The second part, market opportunity, which means market size, category tailwinds within the market, technology disruption, and competitive differentiation. Third thing, the funding ask, uh, unit economics, 3-year growth strategy, application of funds, and the management team. So if these three things are explained in sufficient with sufficient data and clarity, I believe that is the great pitch to see.
Do you have any suggestions to founders how to approach venture capitalists, angels, venture capital funds, whoever they are?
See, a lot of founders say that VC is vulture capitalist and not a venture capitalist. It's because they are chasing growth. But let me tell each founder who's seeing this video today, there is a lot of pressure on the VC because he has to deliver returns. A fund's life cycle is long, and the team makes a return primarily on the capital gains it generates at the time of exit. So there is a name associated with your performance as a fund manager. Else you won't get funds for your follow-on VC round, follow-on VC fund. So founders should know that these aspects, because founders themselves become angel investors and they sit on the other side of the table. So a VC fund has the wherewithal to do financial engineering and even lead the startup to an IPO, and hence maintaining a good relationship in the investor founder relationship is very critical. I believe that this knowledge of how the other side of the table looks like is very important, and each founder should know and educate himself about that.
In terms of intellectual property, how important is for you IP belonging to the startup, of course?
So, Max, we talk about moats in the business, right? I mean, we talk about moats which make it difficult for any deep-pocketed company to create a competitor of the investee company.
Yeah.
IP is like a moat. It's like a defense strategy. So, just as banks, if you take a debt from the bank, they like to keep some collateral, like real estate or stocks or shares. Primarily to avoid the downside. So if something wrong happens, then they have some collateral with them. So similarly, intellectual property for an investor can mean that in the situation that all options fail, the IP is there to monetize and recover some in part of the investment. So for me, IP is like a moat, IP is like a collateral, IP is like a defense strategy. But I would like to tell from your medium all the startups out there that IP is very crucial because it can get you funding as well. So like if you rank all the countries, there is a list one can check on Google, all the countries which provide funding against IP by keeping the IP as collateral. Singapore is number one. You have an IP, they will give you funding, they will give you PR, residency, and a lot of benefits to the company. So having a product which has a unique IP goes a really long way. And for me as an investor, it is also a very important aspect of the business.
That's very you are one of the few that is talking about IP as a collateral. It's something not that much heard from investors, venture capital. That's very great. I do believe so. I do believe IP can be taken as collateral.
Sure. Yeah, I mean, a lot of investors don't see it that way, but the fact is that there used to be a lot of difficulty in some parts of the world to get an exit. And
Yeah.
so, if finding an exit is difficult, then for the investor, there has to be ways in which he can make a return. So, that's why we see it more as a defense strategy.
I mean, I agree. I'm with you. What will be the best and most promising sector to start a new business, a new idea, a new venture in the coming years?
I feel that the United Nations Sustainable Development Goals, the 17 SDGs, are a guiding factor for companies who want to start work in this sector. And a lot of impact money is chasing these SDGs related companies. Impact, of course, means environmental issues, corporate governance issues, and social issues. So impact will be huge for UN SDGs. Sustainability is huge because climate change is for real. I mean, we are seeing rivers drying up in Europe. We are seeing flash floods in Pakistan. We are seeing deluge in Bangalore. So, the rise in temperatures is a reality we are all living with. So I feel that sustainability, impact goals like environmental, corporate governance, social, then smartphone as a platform is entrenched. It is very sticky. People are spending hours and hours. I think the average in India is around 8 to 10 hours every day. So technology led by smartphone as a platform will continue to boom. And apart from that, I also see that healthcare and health tech will be a top-notch sector because the lifestyle-related illnesses, because of a stressed work atmosphere, mental and physical problems because of lack of personal social interactions and a bad lifestyle, they are likely to rise. Uh, Personally, for me, I would like to look at digital detox companies as well because of the extraordinary amount of time which people are spending on screens. There has to be companies who help you out with digital detox, and I feel that it will boom side by side, and many will yearn to return to the roots and nature, owing to health issues caused by too many screens. So, environmental tourism, digital detox, like this app, Calm. It gives you soothing music, close to like nature music. So it's valued in like huge billions of dollars. So, and lastly, uh, I feel that there is a tendency of the governments, uh, especially developed countries, to throw money at any problem. So that sure. I mean, so that means that there is a huge opportunity on the investment side, finance side, fintech side, uh, to capture that free float of money which is floating around in the system, and you can't escape the financial sector. So fintech for me is a huge opportunity as well.
May I ask you, what do you think about the metaverse?
Sorry,
So
I didn't
much
get you.
talk. What do you think
Sorry,
about the metaverse? So much talk.
metaverse. I see. I I am convinced that people would like to see more of AR, VR, and metaverse, but I don't know. Like I find it. I'm a contrarian there, so I find that there has to be sufficient amount of use cases uh, to actually believe that it will turn out to be the next big thing, as everyone is saying. Because I recently read a news report which said that in OpenSea platform, the NFTs sold actually decreased since the last some months. And so, while everyone is out there trying to create a metaverse in the internet, uh, and uh, and the precedence is that gaming companies have been doing it since years, providing these 3D games.
Yeah.
So the precedence is there, but whether that becomes the kind of craze which it is touted as, I'm really not sure as of now. I would like to reserve my judgment and watch for some more time.
I mean, I do agree with you. My point is, we have so much to do in the real economy that we don't need to create another economy. Today, Metaverse, it's an absolutely another economy, which is we don't need. But we have such a huge problem in healthcare, food, water, energy, that I don't think even all the money we have today that we can invest, they are not even enough to cover all these problems. So what I mean, I do believe venture capital should go more on the real side, which means sorting problems, as we always talk about, not everyone does, and less on speculating. Metaverse for me is speculation today.
It's absolute speculation. So whatever the free float of money which is flowing around in the ecosystem, they are trying to capture it through NFTs and through Metaverse. So you are very right. It should go into more productive things. Like there are people who need it for health, education, environment, for women participation, for for there are so many causes which any person who goes out there and realizes the problems, then I think you are absolutely right. I mean, it should chase the real problems.
Yeah, I do believe so. Tushar, thank you so much for coming to the Investor Talk. It's been a very
Thank
great.
you, man. Thank you, Max. It's been a pleasure talking to you. You're really so well learned, and the platform which you have created is also awesome.